Assalamualaikum and hi everyone. Welcome to my channel. In today's presentation, we're going to discuss the consolidation issue. The consolidation issue that we will discuss today is on dividends and interest from the subsidiary company. So dividends and interest from the subsidiary company is actually an intercompany transaction or intra-group transaction. So this intra-group transaction shouldn't be reported in the consolidated financial statement or in the consolidated statement of financial position as what we are dealing now. So the consolidation adjustment will depend on how this intra-group transaction have been dealt with by the parent as well as by the subsidiary. Three situations may arise where the first situation has been discussed in my video before this. You can check the link down the description. And in this video, I'm going to discuss the situation 2, where situation 2 is how should we do the consolidation adjustment when both subsidiary and parent have not recorded the interest and dividends. So no record has been made either by parent or either by the subsidiary company pertaining to the dividends. No record in the books of subsidiary. There are no liability yet being shown relating to the dividends. If you can see here, no information on current liabilities, as well as no record has yet been made by the parent to account for the interest or dividend receivable from the subsidiary. So what we need to do now is to see what should have been done, in this scenario. So you have this information given, and how do you know that the subsidiary and parent have not recorded the interest? So additional information is given down the statement of financial position. Information A is on acquisition of shares and debentures that took place on 1st of August year 3, which is the date of acquisition. So that is the date of acquisition, which is on 1st of August year 3. 1st of August year 3. At that time, the retained profit of Sinovac, which is the subsidiary company, was 10,000. The holding company or the parent company here is Pfizer. Then you have the information regarding the declaration of the preference and ordinary dividend, full year preference dividend. You may also come across some maybe first half or second half preference dividend that could also happen. And there are also declaration being made at the end of the year, somewhere on 20th of July, right before the year end. You also propose, the subsidiary propose as well as the parent propose the 5% dividend. Both parent and subsidiary have not made any record on this particular proposal. C is the information that both parties, the parent, Pfizer, and the subsidiary have not provided for the debenture interest in that particular year. So that also need to be provided regardless both are making losses. Even if losses are made, they still need to provide for debenture interest. Okay, you have the requirement there regarding the consolidation journal entry that you need to prepare, the schedule to compute retained profit of the subsidiary and group retained profits, and a consolidated statement of financial position after taking into consideration the intercompany dividends and interest, which will need to show the extra of current liabilities and group retained profits amount. So the first thing that you need to do is, if let's say you are not sure which situation and you want to check how do we determine it is situation 2. Here are some tips. So how to know it is situation 2? Normally, subsidiary company has not yet recorded its dividend and interest. So how to know that? You need to check the current liability. So here, no information on current liability because I have already informed at the bottom here. But if let's say this is a full version question or the complete exam question, you may have current liabilities. And when you check the current liabilities shown in the subsidiaries book, no item relating to dividends and debenture interest payable are found as part of the liability in the CSOFP. So no declaration has been made. The second way of looking at it is by looking at, do the parent has record for the revenue, which is from the share of dividends and interest receivable. Has the parent made the recorded the so-called income from the subsidiary? So in your case here, the parent has not recorded the income, has not recorded the income yet. Okay, not recorded, and therefore the income from the dividend and interest of the subsidiary has not been recorded. So how do you do that? You go and check the current assets shown in the holding company. If there are no dividends and debenture interest receivable under the current assets section, and those dividend receivable relating to the subsidiary was not disclosed, it shows that the parent has not taken credit for the share of dividends and interest. So how do they take credit? When subsidiary itself in number 1 has not recorded the dividend and debenture interest expense. If that is the case, the parent too may not have taken credit of its share of income receivable in the form of dividend and interest from the subsidiary. So if the parent does not invest in the preference shares, does not invest in the 8% debenture, simply there is no share of preference dividend and debenture interest. But in this situation, the parent invested in all 3 financial instruments. Next, you have the situation in this question where parent company itself has decided to declare dividend, which is in number B, and C is where parent Pfizer also decided to provide for debenture interest. So parent company itself has not recorded its dividend and interest expense. How do you know? No items of dividend and debenture interest payable given as part of the current liability. No current liability. For a question that a complete question, this is just an extract from a complete question. For a complete question of a preparation of a consolidated statement of financial position, you may have to check at the current liability section in the statement of financial position of the parent. And bear in mind, and please remember, this is not an intra-group transaction. This is just the dividend being declared by the parent, and no one is acquiring the parent, and there is no intra-group transaction. The parent is declaring that for its owner, or for the shareholder, or for the debenture holder, if there are any dividends being declared or debenture interest payable being provided for. So we have that information. With that information, first thing that you should do is to compute the percentage acquired. So I've already done this for you, so you can do it yourself. But for information, the percentage for ordinary shares was 90%, preference shares was 32%. Take the units divided by the units. Take the units acquired divided by the units issued. Same goes here, unit acquired divided by the units issued. For debenture, take the amount of investment in debenture divided by the carrying value of the investment. So you have 50% for the debenture and also 50% for the other debenture holder. Parent holds 50%. So let's look at what you need to do. Since the parent has not provided for the debenture interest, subsidiary also has not provided for the debenture interest, you are asked to show the consolidation journal entry. So if you look at the one that I have prepared here, number one is to prepare the consolidation journal entry. So number one, we need to look at in the point of view of the, not the parent, in the subsidiary. I put here, I make a correction here. It should be in the point to the subsidiary company. In the subsidiary company, what would be the record? And here it should be in the parent or in the holding company. I apologize for that. The updates. Okay. Right, so in the subsidiary company, what you need to do is, since it has not been recorded, now you need to provide for the dividend and debenture interest. For the dividend, the retained profit of the subsidiary will be debited. And the retained profit means the profit for the year, which is in the statement of changes in equity under the retained profit column. But that is not the case that we are preparing the statement of changes in equity. So this will be done in the schedule or the analysis of financial statement schedule. So retained profit that will be used is just for the dividend payment. So for ordinary dividend payable, if you can see here, it was 5%. So 5%, the number of shares in subsidiary is 600,000. The amount is also 600,000. So take that 600,000 issued and paid up capital, 600,000, multiply by the dividend rate 5%, and you have 30,000. That should be credited to the ordinary dividend payable under CSOFP. And remember, this 30,000 includes the payment that will be shared by the parent as well as by other non-controlling shareholder. The next one is to record or provide for preference dividend of CSOFP for the full year, if you can see here. So the rate is fixed. How do I know the rate? It is here, 6% preference shares. So 6% from 250,000. 6% from 250,000. 250,000 the amount, because you are given the percentage. So if you have done that, you'll see that for 1 year you will multiply with 1 year because it says 1 year, right? And therefore you will have the amount of 15,000. Right. So that will be debited to the retained profit. And if this happens later when you prepare the schedule, that should be reported in the schedule. I'm going to show you the schedule later because I'm focusing on the consolidation adjustment. The next one is for the debenture interest. Debenture interest was declared in the profit or loss account or provided for as a finance cost. So debenture interest payable is a finance cost. So therefore, you will have to pay regardless you make profit or you do not make profit. So for the finance cost, that means it is the profit or loss before you arrive at the profit before tax. So debenture interest payable of the subsidiary, the carrying amount is 200,000, and that rate is 8%. So you take 8% out of 200,000, that gives you 16,000. So debit the profit or loss. Do not go and debit to the retained profit. If you are preparing the statement of changes in equity, it should be debited to the profit or loss account of CSOFP, 16,000. So this has given rise to the current liability. Current liability, ordinary dividend payable and preference dividend payable, as well as debenture interest payable. That was done by the subsidiary. Part of the dividend paid by the subsidiary and part of the debenture interest paid by the subsidiary, they are actually the being shared by the parent, or there is some portion of it that belongs to the parent. So now parent will have to recognize and account for this intra-group dividends, and as well as intra-group dividend and intra-group, the portion of dividend here means the portion of dividend and the portion of interest payable. So you need to go and recognize the share of the intra-group transaction. Intra-group, I put here transaction, because at the bottom there is the word that relates to dividend here. Okay, parent share of dividends and interest receivable. So if you look at the column here, what was declared by Sinovac was 30,000, and you know that out of that 30,000 that was declared, 90% belongs to the parent. So 90,000 times 90%, sorry, times 30,000, it becomes 27,000. So this is the shortcut method of recognizing the or to account for the intra-group transaction. So this is what you earlier have debited, right, in the retained profit, and now this is being credited to the profit or loss of Pfizer, and that would be 27,000, because 90% times 30,000. The same thing should be done for your preference dividend that you receive from Sinovac, where that 15,000 is the one declared by the subsidiary, but as a parent you have a share of 32% based on the percentage acquired. So you have 4,800, and all these are actually intra-group transaction, or intra-group dividends and intra-group interest. You will report that in the individual financial statement or individual statement of profit or loss of the parent and subsidiary. However, that will not be reported in the consolidated financial statement. So the third one is regarding the preference dividend payable. Sorry, the third one is regarding debenture interest payable. Yeah, so debenture interest payable, what you would do is you will take the amount of debenture interest payable, right, and that 16,000 will be multiplied by 50%, which is the percentage acquired in the debenture. So you have 8,000. So this will later appear in the current liability, where you are going to reduce to the current liability that you earlier created. And because this is intercompany transaction, all this will be deducted against this respective figures. So these are actually income from subsidiary. It is actually income from subsidiary, right? So you can either put here profit or loss, or you can put retained profit, because when you make adjustment, it is to the retained profit, right? Next, what we will do now is to look at the one done by parent. So if you look in the information given, parent also declare dividend, and parent also declare debenture interest. So that was easy. So in the parent's record here, you need to also accrue and provide for dividends and debenture interest payable by the holding company. So how do you do that? So it will be debited to the retained profit for the dividend payable to ordinary shares, as well as dividend payable to the preference shares. How much? You will have to take the issued and paid up capital of the parent for both ordinary and preference dividend. This is similar to what you may have learned before you learn consolidation. So this is the amount for the ordinary shares, and this is the amount for the preference shares. Okay, for the preference shares it was 6% from 500,000. For the ordinary shares it would be 5% from 1 million, and the calculation has been done here for you. And for the preference shares it is for 1 year or 12 months, so that it becomes 30,000. And this is another creation of current liability for the parent, and this should appear in the consolidated statement of financial position, the one that I highlight in green here. The one that I put schedule here means it should appear in the schedule of analysis for the group reserve and non-controlling interest. The last one is the dividend has been done, right? So now we move on to debenture interest. Debenture is not declared from the retained profit, so you are going to debit to the profit or loss, which is profit or loss even before the tax or before the profit before tax, right? So profit or loss, Pfizer, because Pfizer is the parent, so 24,000. How do you get 24,000? Because the carrying amount of the debenture was 300,000. 8% of 300,000, that will give you 24,000. So this will appear in the schedule, this 24,000, but the debenture interest payable will appear in the current liability section of the parent company, and as a whole that will appear in the consolidated statement of financial position. So you need to go and accrue and provide for the dividends. However, since the parent are not being acquired by any other parent, so there is no issue of to have someone else to share the dividends or interest. So now we are going to move on to do the second part. We have already done the consolidation adjustment. This one is done. Done. And now we move on to the second part, which is to compute the retained profits. So if you look at the information that you are asked to prepare here, is just for retained profit of subsidiary and retained profit of the parent company, group retained profit. So if you can see in my schedule that I prepared here, you can see that I first put the balance as per the CSOFP, which is the balance here. As per the CSOFP, this balance for the parent should appear in the schedule, as well as this balance for the subsidiary, right? So it should appear here. So this is 200,000. Balance as per CSOFP is 200,000. So we have to change that because there was some typo there. 200,000. Okay, just change it. And the balance for the subsidiary is 160,000. Just make some amendment there. 160,000, right? Okay, so now the pre-acquisition profit of the subsidiary was 10,000. So there you get the 150,000, right? And from this post-acquisition profit is where declaration of dividend being made. So if you can see here, you just need to take the information that you have calculated earlier. For the dividend payable by the subsidiary, this is the amount that I copy and paste it here. So ordinary dividend payable, the one that you have here, which is all in blue because it has to appear in the schedule, right? So which is the one here, right? So the amount is as per the calculated here, being calculated here, 30,000, 15,000 and 16,000. Alternatively, if you are not required to prepare the consolidation journal, you can straight away do the workings here. You can just do it in the schedule. So this is the working that I also take from the consolidation journal, right? So the one that you have here is the adjusted post-acquisition profit of 89,000. And you also notice that some of the dividend declared here belongs to the parent. For the one belonging to the parent, which is in this section here, only dividend that were received from the parent, so it has been credited, so there is an income from subsidiary. So that is how you report ordinary dividend from Sinovac, 27,000, which refers to this. How do you get 27,000? Because of 90% from this 30,000. And then the second one is preference dividend from Sinovac, the same thing, 15,000 times 32% percentage acquired in preference shares. And here is 8,000. It is 8,000 because you have 50% acquisition in the debenture. So you are entitled to get the 50% debenture interest, and all this are income from subsidiary. These are income from subsidiary that will have to be eliminated later when you prepare the group statement of profit or loss, right? Next one is to record the declaration of dividend by the parent in this working. So you just need to put that in the group retained profit section. Group retained profit section of 50, 30, 24, which represents the figure that you have calculated much earlier, the ordinary dividend payable by the parent. So this ordinary dividend payable are expenses, right? Sorry, it is actually an appropriation out of profit, but the debenture interest payable are expenses. And preference dividend payable also is an appropriation from the profit or loss of the parent as well as profit or loss of the subsidiary. So what is the effect in the next section, which is to prepare the group statement of financial position. So we are done with this. Now we are going to focus on the last one to show the extract of current liabilities and group retained profit in the consolidated statement of financial position. So what you will do here is that you will report the ordinary dividend payable by the parent, Pfizer, which is this one. Debit retained profit, you credit ordinary dividend payable earlier. So when you do this, right, so here is the journal entry. So there is a current liability. And there's another ordinary dividend payable that are paid by Sinovac, this one, right? And that was 30,000, or you can check here, 30,000. Just go and check in your schedule so that easy for you to cross refer. So I have put the arrow there. This one will be here, right? However, you need to go and deduct or reduce with the intercompany transaction of 27,000, since that is intra-group dividends from Sinovac. So you just report 3,000, and that 3,000 is the only dividend payable by Sinovac, the subsidiary, to the non-controlling interest. The one payable by parent itself is 50. So the total of these two ordinary dividend makes up 53,000. The next one is preference dividend payable by Pfizer, which is the parent company. So preference dividend payable 30,000. So this 30,000, right? 30,000. So it should be here. And then you have another one, preference dividend payable by Sinovac. So this 15,000 here. I've already shown the workings should be here. But you must go and reduce with the intra-group preference dividend of 4,000, the one that has been credited to the retained profit of the parent company. However, these are income from subsidiary. It shouldn't be reported in the consolidated financial statement. So what you will report is not 15,000, but will be 15,000 minus 4,800, which is 10,200. The next one is for the debenture interest payable. Take the debenture interest payable of the parent first, because no adjustment needed. 24. Debenture interest payable by parent is 24, right? Which is here, 24,000. And take the debenture interest payable by Sinovac. The one by Sinovac was 16,000. We have earlier calculated. But the share of parent in the debenture interest of Sinovac was 50%. So you have 8,000. So that has to be adjusted with 8,000. And there you go. You have 8,000 there. So this is how you present the ordinary dividend payable. You can also join together this in one row, but that will make you more mistake if your calculation is incorrect. So my suggestion is to split the dividend by parent as well as by subsidiary to the non-controlling interest. And same goes for the debenture interest payable as well. Split between the one by parent and the one payable by the subsidiary to the other debenture holder. For your information, in the consolidated statement of financial position, the intra-group dividend, which refers to this, these are the intra-group dividend. I just put a little in that box there, right? That should be not reported in the consolidated statement of financial position, and it has to be eliminated and cancelled off. We have done it already. And only debenture interest payable to outside debenture holder, if you relate to the subsidiary, yeah, it was 8,000. If you relate to the parent, it was 24. And dividend payable to the non-controlling interest will be disclosed under current liabilities in the consolidated statement of financial position. Okay, that's it. For the group retained profit, you just need to copy and paste the group retained profit figure here. We're not doing any other things related to non-controlling interest. As I said, our focus is for the how we go and adjust for the intra-group dividends. Now bear in mind this 89,000 of post-acquisition profit also needs to be shared by the parent, and should you be asked to prepare the non-controlling interest, 10% of 80 of this figure will go to the non-controlling interest column. But here it was just focusing on the case of group profit and retained profit. With that, I thank you for watching, and remember we were discussing just now situation 2 where both subsidiary and parent company have not recorded the interest and dividends. I thank you for watching. Thank you for listening. I'll see you when I will see you. Assalamualaikum and have a good day.